Strategic asset allocation. Asset allocation is the process of structuring a portfolio by deciding weights to be allocated to the available asset classes. Asset allocation is the most important driver of return stability over the long term and accounts for about 90% of the returns. As you can see, no single asset consistently outperforms other assets. Different assets do well at different periods of time because of differences in the underlying factors impacting risk and return. As a result, asset allocation has a significant impact on portfolio returns. As per Morgan Stanley's report, we see that in the long run, the average investor underperforms, as no investors tend to enter and exit the market at inopportune times. Strategic asset allocation is a traditional approach to building a portfolio. It provides a roadmap to meet their investment objectives over the long term and reduce the volatility. The basis lies in the modern portfolio theory. The modern portfolio theory says that markets are efficient, and it is possible to create portfolios that provide the best balance of risk and reward. Graphically, this is known as the efficient frontier. This offers the best chance of achieving a desired return at the lowest possible risk. The portfolios are anchored around strategic asset allocation, which is based on capital market forecasts of long-term averages, average return, average volatility, and average correlations. The allocation process starts with assessing the client's investing time frame, tolerance for risk, and required rate of return. The allocation is built to generate best possible returns at the given level of risk. Strategic asset allocation can be implemented by determining the risk profile of the client and assigning a model portfolio that reflects their preference. Questions are designed to gauge the willingness to take risk and the ability to take risk, and the output of this puts the investor in a bucket of conservative, moderate, or aggressive category. There is no single model portfolio for each investor or for each stage of that investor's life. Many individual features of the investor, such as age, risk preferences, targeted goal values, liquidity needs, have to be considered in constructing an appropriate portfolio. Investor profiles may be broadly defined as aggressive, moderate, and conservative, and the asset class selections and risk-return outcomes will vary depending on selected model portfolio. Practically, when onboarding a new client or getting fresh funds, their portfolios need to be as aligned to the model portfolio as far as possible, with exit loads and tax consideration taken into account. Assets have become more highly correlated in recent years due to greater interconnectivity between global markets, thereby reducing diversification benefits. The ongoing expansion of asset allocation to non-traditional asset and sub-asset classes has changed the traditional asset allocation. Strategic asset allocation does not focus on exploiting short-term valuation opportunities caused by a change in sentiment towards different asset classes, and the diversification benefit disappears at times of market stress when its value is the highest, because correlation among risk assets converges.